let's go to more on the muni market because we're right here in Lower Manhattan for BAM Mutual. We're going to dissect all areas of the muni market. Joining us now here on set is Mark Paris, head of municipal bonds over at Invesco. Mark, good to see you. Thanks for being here.
Good to see you. Thank you for having me.
Let's pretend like I don't invest in munis, and somebody has been telling me for a while to invest in munis, and then I come to you and I say, hey, what should I invest in munis? What do you tell me?
So I think that the best part about the muni market is it's not what you make, it's what you keep. And so the tax exemption is really key to investors. And I think that the basic concept is that school districts, hospitals, toll roads, they get to invest at a lower interest rate because what they pay is tax exempt and the investor can gross it up. So my advice to investors is you want to have a diversity in your portfolio, whether you create that or a manager creates that. You want to have knowledge of what you own. My kids always joke with me when we go to a town. They say, "Oh, Dad, I know you own the hospital, you own the toll road, you own the university."
But they know what you do. That's so nice.
Well, they're older now, but the idea is that these are things that you can see, touch, feel, drive on, and they're good projects. And as you heard Nora talk about the credit quality of the muni market, it's a fun place to invest in. It's a tax exempt place to invest in. And then if you get into lower credits, then you're going to want a professional money manager to help you out if you want to go out longer on the curve or things like that. But I would say diversity is important, and I would say that these are the things of essential services that we live and breathe every day.
What are some of the sectors that you guys like these days?
So I think transportation is really a key sector in this country, whether that's a train line in Florida or airports. I always have people come into the city to visit me, and they come through LaGuardia, and they say, wow, that place looks so different now. Well, we just redid it.
Oh, man. Yeah, but that was a long time coming, but okay.
That was a long time coming, but now JFK is going through the same process, and they had bonds. So airport bonds, great origination and departure fees, the concessions that go on at the airport. We see that transportation part of the economy is always sort of, humming here in the United States. So that's been a good part of what we do. We also like toll roads. We also like water and sewer. We like to say you wake up in the morning, you turn the lights on, we own the power company. You go to brush your teeth, we own the water company. You get in your car and go to work, we own probably the toll road that you go on. So, we like essential service revenue bonds, but we'll also buy some universities, some hospitals, but that's where you want to do a little bit more credit work.
Okay, right. So I was going to say, where are the riskier parts in the muni market? I mean, clearly, like what you're saying, the infrastructure, tolls, water, like that feels like the safety bet in the muni market from what you're saying. Am I right in that? And then where's the risky bet?
Yeah, absolutely. Look, I think you have to look at smaller universities these days, universities that are private, that have smaller enrollment, smaller endowment, that are kind of changing their standards to get people in, and that may have too big of a debt load. It's the same thing as in the corporate market. It's a matter of how much leverage a borrower takes on. The hospital sector has been interesting to us because some of them have spent some of their COVID money a little too quickly. But then again, you have hospitals that are doing elective surgeries, hospitals that are in the birthing business that are doing just fine. So, credit work is really important, not just to say I don't like that sector or there's bad news in that sector, but what are the actual individual credits that are going on? We are a finite market. Once an issue comes to market, it's going to trade for a while, then it's probably going to disappear. So it's really important to do individual credit work on some of the different aspects of some of the lower credits.
As an institutional investor in this market, how do you rate the risk of the taxability, losing some of the tax efficiency of this market, whether it's some change in tax laws or anything like that?
So I think it's a headline that we have to watch, but I think the headline is going to outweigh the actual changes that happen. I think there may be some tweaks. I know that the House Ways and Means Committee put it on their list, but it was kind of down the list. And if you look at what they had adjusted for the cost, it was somewhere in between the savings. I think Nora was very on top of things in her answer where, she talked about the fact that other things will go up if that happens. It's a difficult thing to do, too, because what do you do with the existing bonds? You probably have to grandfather the existing bonds. You cause a bifurcated market. We saw this before in the muni market, mostly after the global financial crisis. And what we found was there was a really good grassroots effort of school districts and hospitals and universities to say, hey, we don't want to borrow at the higher rates. It's not a good idea. So Obviously, in this administration, we're going to have to wait and see how things, kind of play out. But I'm not one of those, folks that's in a panic over it. I think there's going to be a lot more headlines about it, but I just don't see a higher probability of it.
Knowing very little about how the muni market works, where do issuers usually issue along the curve, and where is the best value?
So it's interesting that we used to just see long paper, 30-year bullets or 30-year, 10-year calls was really a standard thing to do in the muni market. Separately managed accounts have become such a big part of investors' portfolios, of the products that we offer in the muni business. And so there is a lot of issuance, 0 to 10 years, 5 to 15 years. We actually like sort of the 20-year part of the curve. We think that, the muni curve does have its steepest curve in the fixed income market, and that's because investors want more yield for longer periods of time that they go out, just like they want more yield in more credit risk that they take. But the 20 to 22-year part of the curve to us looks really attractive, both on a percentage to treasury basis and where you get the most bang for your buck while not going all the way out on the curve.
All right, 30 seconds. Are you guys active buyers of new issues?
Yeah, absolutely. I'd say sometimes it's 50-50, sometimes it's 60-40. We do a great job of negotiating with the underwriters and making sure that the issuer understands what our concerns are, whether that be getting a mortgage or a debt service reserve fund. And then we help structure the deals, what type of coupon we want, what type of call they want. So there's a lot of back and forth.
You just don't pick up the phone and take my sales pitch.
No, we don't.
Ah, interesting.
That's cool stuff. Mark, thanks a lot. Really
Thank you so
appreciate
much.
it.
Great
Mark
to be
Harris,
here.
Head of Municipal Bonds. You were definitely welcome back. He's joining us at Invesco right here at BAM Mutual.